Okay, so this is problem 10.1b, and it's really working through current liabilities. And when you see a problem like this, you can see that they're going to want you to prepare the current liability section. So we start off with, we should put the beginning balances in here. We had accounts payable to start of $35,000. We had notes payable to start of nothing. We had sales tax payable to start of $5,000. And we had $12,000 in unearned revenue. And so we'll just go do the journal entries real quickly and then post them as we go along. So 1-1, we borrowed cash from the Plattsville Bank on a 6-month note. So 1-1, we got some cash, and we have a note payable for, let me allow a little more room here, for $30,000. Okay, so that's our first journal entry, and so we would just go notes payable, $30,000. Okay, so we got to keep track of our liabilities. We sold merchandise which included a 6% sales tax. So on 1-5, we know we got some cash. We're going to have sales tax payable, and we will have sales revenue. And how do we compute the amount? Well, we're given the total amount in the drawer, or the total amount we collected was $11,130. So we take $11,130, that's the total amount, we divide it by 1 plus the sales tax. When we do that, we come out with the amount of sales, which would be $10,500. You can do a couple of things here. You can go $11,130 minus this will give you the sales tax. And to double check it, you can go this times 0.06. Should also gives you the sales tax of $630. The $630 plus this should equal the amount in the drawer. So if we had $11,130, we've got sales of $10,500 and sales tax payable of $630. Okay, so we'll get this out of here, and we post the $630. The next thing that happens is we performed services for the customers who had made the advance payments of $12,000. So this is referring to the unearned revenue that we collected the cash earlier, but we had not done the work, so now we've done the work. So we debit our unearned service revenue, and I'm just going to do unearned revenue, and we're going to credit our service revenue. And they said that we had earned $8,000. Double check that. Yes, $8,000. And so we will post it. Yes, we earned $8,000 of that. Then we paid the sales tax for December of $5,000. So on the 14th, we would reduce our sales tax payable because we've just paid it. And we would write a check for $5,000. Okay, so here's our sales tax payable, and we have reduced it, so we will debit it. We sold 750 units at $44 plus sales tax. Okay, so here we simply have to take the 750 times the $44 per unit. That gives us total sales of $33,000. Then we just go times the sales tax, which would come out to $19.80. And the amount that we have, we sold these on credit, and so we would have an account receivable of the $34,980. So on this particular date, we would go accounts receivable, and we would have our sales tax payable, and our sales revenue. Okay, and so that would be, the total receivable would be the 34,980. The amount of the sales is 33,000, and the tax we owe is 1980. Okay, and so we would want to update our sales tax payable. The last thing they want us to do is to accrue the interest for the month. So in 131, we would go interest expense. This is on the note payable, and interest payable. And we'd have to figure out how much it is. It's a $30,000 note. So, get this out of here. We'll do a little more work here instead. So we would go the 30,000, and the interest rate on the note is 6%. So we would go times 0.6, and that would give us the annual. And I'm not going to do that. That would be the annual, and then we divide it by 12. So the easier way to look at that is to go 30,000 times 0.6 times 1/12 for 1 month, and it comes out to $150. Okay, so that takes care of that. So we would go interest expense 150 and sales tax payable. I'm sorry, interest payable. Okay, so now we have all of our T accounts done. So we have the balances. And so presuming that you have all of this down, we can now move on to do our current liabilities section. Oops. Okay, so we would go current liabilities. And usually Wiley does the notes payable first and then the accounts payable. So you'd go notes payable, and then your accounts payable. And so we would have 30,000 of our notes. We have 35,000 of accounts payable. We have unearned revenue. And the balance there is the 12 minus 8, or 4,000. We have the sales tax payable. We paid 5,000 of it. So when we add up the remaining items, we end up with sales tax payable of 3,546. And we have our interest payable, last but not least, of 150. Okay, and then we would want to have our total current liabilities. And hopefully we would add these up and get 72,696. 72,696. And that should be our total current liabilities. Okay, so that's problem 10.1b.